I open up my count and I see 193% growth on this one stock, and then I see a 64.71% increase on this stock, 47.07% on this other stock, and 12.36% on this one. Hey, don't judge that 12.36%. That's still nice growth. So why did these stocks soar so high? What stocks are they? Why you might be panic selling incorrectly? And yes, even a few stocks that have lost me some money. That is what we're going to cover in today's video. Are you ready to go? Then don't be dumb. Tap the thumb on the video. So why did these stocks soar so high? We're talking 193% growth. Well, if you're a first-time viewer to this channel, what you may not know is that I'm a big long-term investor. I like to look for the long-term millionaire portfolio. I'm not just talking about getting in very quickly and getting out very quickly. We're talking about building up our millionaire portfolio over a good period of time. And what we look at is we look at good logic and good fundamentals to build up our stock portfolio. In fact, yes, chasing meme stocks can be fun, but a few people have found out the hard way that buying right here at this point, they get screwed and they get scared as everyone who did profit gets out and the stock price settles back down. Then they gotta wait for it to hopefully go back up, and sometimes it never feels like it's going to. So all of the funds today that I'm sharing with you as part of my growth portfolio are part of the fact that it's a long-term investment based on fundamentals, and I'll explain exactly what that is as we go through the video. So I'm sorry if I'm disappointing you if you're expecting to see the meme stocks as my 193% growth, such as an AMC, a GameStop, Workhorse, or Sundial. No, it's none of them. Now, as I share today's stock, this is not financial advice. It's for entertainment purposes only. Remember, I'm just some guy on YouTube who sometimes looks like Woody from Toy Story. Do your own research. Now, let's start off with the 12.36% growth that I've had, because I think this one's super important to understand. Believe it or not, the stock is Apple, ticker symbol AAPL. Now, I've actually been buying Apple in small increments since 2018. And the beautiful thing about that is because, especially back then, I didn't have a whole lot of money to invest because we were still getting out of debt. So whether that was only $5 or $20 a week, I invested consistently from that period all the way up to today. And thanks to things like Robinhood, which is linked in the description, I'm able to invest in whatever stock for a minimum of $1 or more. It allows me to get in with less amount of money and build that portfolio over time. So this one is not actually related to any type of buying during the pandemic crash of March 2020. I've been doing this consistently, even pre-pandemic. Now, by the way, today's video is brought to you by the subscribe button. Hit it. Now back to the video. Now, even if we look at our recent purchases of Apple, here's what I got going on. So in February of 2021, February 1st, for $135.18 per share, that was the price at the time. I put in $20, so that fraction gave me about 0.14795 shares. But then just over a month later, it drops in price from $135 down to $119.93 per share. So my $20 that I put in became less money, and here's how you calculate that. You take the current price, which is $119.93, times how many shares I owned, 0.14795. My $20 became $17.74. So should I cut my losses and sell at that point? Hell no, I'm gonna buy more, and that's exactly what I did. In fact, I sunk in $54 to buy an additional 0.4531 shares when that price went down. And then every week I kept putting $20 in to Apple consistently. Boom, 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 every single week. So the beautiful thing is when you buy when the stock price is going down instead of freaking out and selling, you do what they call dollar cost averaging. Your average cost per share starts going down. And then when the share price goes back up, you start profiting a little bit quicker. So because I've been doing that, I now own 13.4 shares of Apple. And my average price per share is $126.29, thanks to the dollar cost averaging. Now today, as of the recording of this video, ticker symbol AAPL is going for $141 per share, meaning my overall value is $1,904.05, and that is up 12.36%. See, here's the deal. In this article by CNBC, panic sellers during stock market dips are often married men with children. Oof, I feel that. Women tend to use more logic during stock market crashes. Shout out to my ladies watching this video. But married men, often over the age of 45, tend to sell at a loss when stock market fears happen. Well, why does this happen? A lot of times men feel, according to this article, that they're trying to protect themselves. They got a family to provide for, they got a wife, they got children, they got everything going on. So they're worried. They want to cut their losses before their losses become even more losses. So they freak out and they sell. But guys, we got to reprogram it. And in fact, I've reprogrammed my brain to not panic sell when things start happening, but to panic buy when the opportunity presents itself. Number one, you don't invest money that you need for your everyday life. If you start investing money that you need in the hopes that it's going to go up and instead it goes down, you're going to freak out and say, hey, I needed that money, I need it back before it loses even more money. Get yourself out of debt, do some side hustles, get your income up, and then what you can do is take that extra money that you don't need because you've lowered your expenses and you've increased your income. You can let that money go into the stock market and not worry about it. Number two, you got to invest with intentionality. Don't just go after something because some YouTuber is talking about a hype stock. You got to make sure that you feel good with it, that logistically it makes sense to you, and you can check out the video, I'll link it in the description as well as up above in the info card, on 10 steps on how to analyze a stock. You got to look at, is this stock going to be something that I can invest in long term and not worry about it? Even if it does dip, it has the strength, it has the consumerism, it has what it needs to continue to grow over the long period of time. And number three is invest on a schedule. This has got to be a stock or an ETF that you believe is going to be a long-term game. Just like my Apple stock. I don't care if it was $135 a share or $119. If it was $119, I may have put more money into it, but I still consistently invest on a schedule because I believe in that company and I believe in certain ETFs, and I follow these ETFs because I believe in what they have to offer, and I don't really care what happens day by day, month by month. Here's where your logic becomes a little bit more focused when the market does crash. In March 2020, we know that the market crashed pretty hard during the pandemic, and these next stocks, especially my 193% gainer, happened during this period. So a massive sell-off occurred right around February, March 2020 because of the pandemic hitting. And one area that really got hit by this was the travel industry, and especially cruise lines, airports, airlines, and things like that. And this is where my logic stepped in. I said, well, wait a minute. Right now, everything's going to be put on hold. Cruises aren't going to sail anymore. Airplanes are going to be grounded for a little bit while we get the pandemic under control. But this is an opportunity because I believe people are going to want to go on cruises again. They're a lot of fun. People are going to want to travel again. People are going to need to use airplanes, not just for leisure, but also for business. These things typically are going to go back up. So I said, you know what? Their financials, their typical fundamentals will look bad for a little while. Why? Because they're closed down. They're not bringing in any money. But my logic is people will come back to this. And eventually that will rebound itself. So I started looking at things like Royal Caribbean Cruise Line, Carnival Cruise Line, and yes, even looking at Delta Airlines. Let's take a look at these and see how I got 193% gain. Let's start with Royal Caribbean Cruises. You can see the price falls hard in February to March 2020. In fact, even today in 2021, it's not even back to its pre-pandemic stock price. So I still think it has some room to grow over the long period of time. On March 9th, 2020, I decided to buy 5 shares of Royal Caribbean, and the price at that time was $49.02. Then the price keeps falling after that. Later on in the month of March, that could have freaked me out. I could have panic sold and cut my losses, but I had faith in Royal Caribbean. And again, it was money I did not need. It didn't matter. And even if it takes 5, 10, 15 years, I said to myself, I'm sticking with Royal Caribbean until the promised land. So March 23rd, the stock price falls even more to a price of $22.90 per share. So I picked up an additional 10 shares on that day. That gives me a total of 15 shares that I own of Royal Caribbean. So my total cost for the 15 shares was a total of $474.10. Now, as of today, as of the recording of this video, it is up 193% to $1,389.60. And remember, revenue is going to be low. Things are going to be offset for a little while until they bounce back their business and they start cruising more consistently again. But I feel that we have some room to grow with Royal Caribbean, so I'm holding on. I'm having fun with this one. So I'm not really sure yet when I'm going to decide to sell this and maybe invest it into a more conservative total stock market ETF or something like that. But in the meantime, we're hanging on, we're having fun. Let's look at Carnival Cruise Lines. I also bought into them a little bit more than I bought with Royal Caribbean. So I'm up 132% on that stock. I bought 10 at $21.76 a share. Another 15 at $15 a share, and then I went all in with 50 shares at only $8 per share. That was probably the lowest price I saw on Carnival, and I'm like, I gotta go in. I gotta do this. I got the cash available. 50 shares, let's do it at $8 a share. Today, the price right now is going for $26.17 a share, and that is where I'm up 132%. Then let's look at Delta Airlines. I also love Delta. I fly Delta all the time, so I have a lot of love for that company. 64.71% up on Delta. I earned 7 shares at an average share price of $26.37. Price today, it's going for $43.44. So with all this information that I just gave you, you might be wondering, should I just wait until the next crash? No, don't forget about my Apple example that I just gave you. That is the result of consistent investing. And yes, I had money in Apple when it crashed during the pandemic, but I also had money consistently invested that entire period of time, which is why it's up 12% despite the pandemic loss. Let's look at another example. I'm invested in Vanguard's ticker MGC. Now this one is up 46% 37% on the ETF and an average share price of $104.98. It's now going for $154.40 a share. I've been investing consistently in this since 2017. So I didn't just pick this up in March 2020. This one is another consistent investment. But it's not all rainbows and sunshine, my friend. No, here's some ones that I have lost money on and I'm still hanging on for dear life. I've got some weed stocks. Ticker symbol MJ. It's kicking my butt, and it's been kicking my butt for a long period of time since about 2018. I'm still down 35%, 35.18% down on this ETF. I'm at a loss, but I'm not going to sell it. I'm going to hold this ETF until it decides to do something. I'm holding this thing until it goes positive. Another painful stock that I own is Beachbody, B-O-D-Y. And the problem with this one, it's down 22.02% as of today. Beachbody has not yet come out with their financial statements. I'm basing this one on logic and the fact that I do like what the company does. I think once they start producing their quarterly statements, because they are an IPO, they just listed on the stock market. But once we start getting some financial data, because they're a debt-free company and they operate off of debt, I'm expecting to see a phenomenal looking balance sheet. I'm expecting to see good revenue. And if I do, this stock price should go up. Again, not financial advice for you. This is what I'm doing. Now, what you should do next is watch this video on how to analyze stocks. Watch this video if you're a new investor, and we'll see you on the next video.